So you're a normal person, you're trying to reach financial independence and retire early. You need to make a lot bigger returns than what a regular S&P 500 would get you to get there, so you can retire in 10 years or less. Well, how would you do it? How would you get the bigger returns? Well, I got you. Let's talk about it. I'm Nate. I'm the FitfutureMD. I help you with your finances. Go to Ensorsale.com and pick up a cool inspirational t-shirt today, like this difference maker t-shirt. Obviously, you've seen what's happened in Western North Carolina, this weekend. And obviously the difference makers are up there helping as many people as we can, and shout out to them. Hope y'all stay safe and praying for you. But go to Ensorsale.com and use code FitfutureMD for 20% off if you want to pick up a cool inspirational t-shirt. Now, one of the ways that you can get a higher return, obviously higher returns are bigger risks, and this is not financial advice. This is just how I did it, right? So back in 2020, they gave us a $1,200 stimulus package, right? And what I did with that stimulus package is I put it in the stock market. Obviously, I had no idea what I was doing. I just saw that a couple of companies were doing what's called SPACing. You can also call them what's called an IPO, right? Initial public offering. And these companies were Nikola and Helion, right? So I took all my $1,200 and I put it into Nikola at $11, right? Nikola went all the way up to $80. I, of course, sold at $40, $40-ish, right? But, this is one of the ways that I jump-started my investing at all, right? Like I would, obviously if I lost the $1,200, I wouldn't have kept investing, right? Or kept learning how to invest. And then I did the same thing. I basically repeated the process. I found another company that was basically doing something similar that was SPACing or IPOing, and I got Helion at $15 and I sold Helion at $36, right? It went all the way up to $50, 50 something dollars, right? Now it's down at $2. But the point is, this was one of the ways that you can make higher returns is using what's called an IPO or initial public offering. And I'll give you some examples other than the ones that I did that would have given you outsized returns, right? Over the long term, not just the short term like I was doing it, right? So Tesla in 2010, it's up 20,000%, right? So if you put $1,000 into Tesla in 2010, today it would be worth 200,000, right? Google in 2004, these are both ones that I could have participated in, right? So Google 2004, it's up 6,000%, right? So $1,000 into that would be $60,000 today, right? So these are what's called outsized returns. You're making 20,000%, 6,000%, right? Obviously you do the math there. It's been, 14 years for Tesla. It's been 20 years for Google, but so you divide those over the years, that's still a crazy return, right? But I'm gonna give you a complete list right now of initial public offerings, IPOs since 2018 that are up 500% or more, right? So you got Beyond Meat, you got Zoom, you got CrowdStrike, you got Moderna, you got Peloton, you got Cloudflare, you got Bill.com, Pinterest, Fiverr. So, all those are over 500% from their initial price, right? So it's just an idea. So this is the technique that I use. It's obviously not financial advice, but I'm gonna take a small portion of my portfolio, right? Most of my portfolio is obviously going into dividend stocks. We want them to pay us every month and guarantee a return, right? So guarantee 3, 4, 5% return. And we want companies that continue to grow that dividend, right? But I'm gonna take a small percentage, 5 to 10% of my investments, and I'm gonna put them into what's called IPOs, right? So There are websites out there that list the IPOs and the IPOs coming up, and you can research those companies and figure out which ones you would want to invest in. But the idea is you take $1,000, right? And it doesn't even have to be 1,000. So say you don't even have 1,000, right? Say you only have an extra $100 a month to invest. You can say $100 instead of 200,000, you would have 20,000, right? On 100. I mean, that's a no-brainer for me, but that's how you change your stripes, right? Like you invest in these companies early so that when they do grow, you got the most growth out of it, right? But so Nikola's not going to work out. Obviously, it's still in business, right? And you can get it for very, very cheap now. That $100 would probably be 50 shares or more now. And then one of the big things is if you're going to invest in a SPAC long term, right? So there's getting that initial run up, right, when it first IPOs, and then there's what I call a grace period or a lockup period, where the inside investors, the ones that started the company, the ones that invested early in the company before it IPO'd, they can't sell their shares, right? Usually it's around 6 months, sometimes it's a year. But usually after that 6 month period, you'll see a big drop off in the stock, right? And where they're cashing out some of their money that they've invested or getting their money back that they put in, right? Because that's called the flow of money, or the flow of money. Basically, the idea being, say you put 1,000 and the stock went to 2,000, then you would sell 1,000 to get your 1,000 back, so you could do it again somewhere else and let the other 1,000 grow or lose money, whatever. But that is IPOs in a nutshell, right? And they can be big time wins, and they can also go to zero, right? So, so I'm gonna go through the list of cons of the IPOs, and we'll see what you think about them, right? So, number one con of IPOs is what's called high volatility, right? Well, if you're a day trader, that can be a good thing. High volatility can be a great thing because you can use the volatility to sell high, buy low, right? Buy low, sell high. So you can read the stock, read the charts, and predict when it's going to go up, when it's going to go down. Sometimes you're 90% you're right, 90%, 80 to 90% of the time you're right, 20% you're wrong. You just got to make sure that you're making more when you're right than when you're losing when you're wrong, right? And that's the hard part of day trading, right? But so high volatility, right? So if you are somebody that can't sit there and watch a stock go up and down, up and down, up and down, up and down, IPOs are not for you, right? If you just want to see your stock doing this, you might want to stick to the S&P 500, right? Number two is you have limited info. I'll give you a story about Nikola. Literally, this guy that was the CEO of Nikola, owner of Nikola, he literally pushed his truck down a hill to make a video where it looked like the truck was actually working, and it wasn't. It was fraud. So you're really limited on the info that you have with an IPO, right? You're uncertain on the evaluation, right? So it's very speculative on what is actually the company's actually worth right now, but it doesn't matter because in 10 years it's going to be worth more, or it's going to zero, right? So you have to choose that choice, that risk, right? Obviously, it decreases after the lockup period when people try to get their money, and obviously SPACs can be overhyped, IPOs can be overhyped. Nikola was definitely overhyped. Helion was definitely overhyped, but Beyond Meat wasn't, right? Zoom wasn't, right? CrowdStrike wasn't. So keep that in mind. Obviously, Peloton, Pinterest, they're all examples of IPOs. But this is how a person that's a normal person that maybe has $100 extra, $50 extra, can say, hey, I'm gonna take this risk, this higher risk on an IPO, on an initial public offering, and maybe get outsized returns or have that $50 go to zero, right? Obviously, you know, I use some of them sometimes to day trade, or to swing trade more often than not. But this is IPOs. Tell me down below if you would invest in IPOs to get that higher return, or you're going to stick to the S&P 500. I'm Nate. I'm the FitfutureMD. Shop at Ensorsale.com. If you're looking for cool inspirational t-shirts, use code FitfutureMD for 20% off, and we'll see you in the next one. Peace.